Good evening, good evening, good evening. Hello, real women. God bless you. Good evening tonight. We are so glad to have our first live session. Woo! Can I get some clapping emojis in our chat? We just thank God for this opportunity to come live. We're so glad to have all of you. Thank you, Sister Lisa, for joining us. Thank you, Marcia. I see Mary Young here tonight. Thank you. Jakaya is with us tonight. We are just so ecstatic to have you all, and we're just asking that you please like and share this live tonight. We're going to be talking about life insurance with our good friend, Mr. Jason Ford. He's not a stranger to many of us, but he may be to some. And so I just want to introduce you all to a really good friend of mine. I've known him down through the years, but I'm going to ask him to come on into our session. Mr. Jason Ford, come on, let's give it up for him.
How
All
you doing,
right.
Dana?
Thank you all the way from Atlanta, Georgia. We are so glad to have you today. We're going to give a few more minutes for some others to join us. All right. I see Danielle Haynes is with us in the balcony. Thank you. Thank you. I see some more Atlanta folks. Ivy Styles, good evening. So glad to see you. Latoya, welcome. Welcome to our first live. We did it. Oh my goodness, this has been a work in progress, but we are so grateful to have this opportunity to share with you all about life insurance and how to protect our families, our wealth, and our income. And so I'm just so excited to see all of you all. Please share and like our session today. Good evening, Ashley. So glad to have you tonight. Come on in, come on in, come on in. I need to see some clapping emojis. I need to see some happy faces, some hearts. Come on, spread the love. Thank you so much. We believe in getting started right on time. So we want to do that because we are an hour difference with Jason. So we want to be right on time as we have scheduled. All right. So I just want to give a little background information. Jason Ford is a financial coach with Ford and Associates. He is a 2000 magna cum laude graduate of Florida A&M. Come on, somebody. Yes. He majored in computer information systems and minored in business administration. Jason got started in the financial service industry in 2010. Okay, so he's not new to this. After reviewing him and his wife's current retirement plan, they noticed that their money was just not working for them, but it was working against them. Why? Due to nobody teaching them how money actually works. So, like many of us, Jason and his wife were on a path to working until they were 70 or 80 years old. Now, I'm a podiatrist and have been one for 24 years. And someone just asked me today, well, how long do you have to work? Do you have to go to 65, 70, 75, 80? I said, ooh, hopefully not after tonight. All right. Okay. So he was on his way, Jason and his wife were on the path to working until they were 70 or 80, but that was not the plan that they wanted for their lives. And so we are just so happy tonight that he's going to share us what he has learned so that we don't have to be on that path either. Isn't that right, Jason?
That is absolutely correct.
All right. All right. And so I don't just bring you all anybody. We bring you all guest presenters and speakers who are at the top of their game. And Jason is no exception. I have known him from as long as I can remember. His house is the kind that I can go into the refrigerator right now. Okay. Right. That's how long we've known each other. So everything that he's talking about, he is passionate about, and he is on a mission to inform as many people as possible that we do not have to live in lack. What does the Bible say? For the people perish for the lack of knowledge. So without further ado, I'm going to turn it over into the hands of our very capable Jason Ford, all the way from Atlanta, Georgia. Let's receive him at this time.
All right. Thank you so much, Dana, for having me on here. I bring greetings from Atlanta, Georgia, and so we're gonna get started right away. And so, for those of you may or may not know who I am, actually originally from New York, but my parents moved to Atlanta almost 30 plus years ago. My initial background is not in financial services. My background, as Dana stated, is in computer information systems with a minor in business administration. But I got involved in this industry 14 years ago. And the reason why I got involved is because, as Dana mentioned, my wife is an educator. She's been teaching in the school system for over 25 years now. And when we was looking at her retirement account, it was literally putting us in a position where we had to work to about 70 or 80 years old. And I knew that could not be the financial game plan for my family. We have three girls that are 18, 16, and 9. And working to 70 or 80 was not the game plan. So at that time, I had a financial coach come sit down and teach us some basic principles on money that was never taught to me growing up. And once I saw what he was doing, I said, I got to do what you're doing because I know there's a need in our community because financial literacy is lacking. And he said, well, Jason, all you have to do is get a license. And so that's what I did. And so when I put together my management team, we're on a crusade to help families create what I call generational wealth. And in order to create generational wealth, there's three principles to wealth that I coach people on. I'm going to give you all three on tonight, but my main focus, or I was asked to speak on the last principle on tonight. So the first principle to wealth is you want to save as much money as you can, as fast as you can. So the first principle to wealth is save. And I want to make sure I give us some scripture behind it. All right, so you can write down in your notes Deuteronomy 8 and 18. Okay, you can read that at your own leisure. But that's going to go with save. The second principle to wealth, I call it good. And that stands for get out of debt as fast as you can. Get out of debt as fast as you can. Because I believe you have $50,000 saved, but then you also have $50,000 worth of student loans, credit card loans, or car loans, you have no money. And for the scripture, we're going to use Proverbs 22 and 7. And I'll read that real quick. It said, the rich ruleth over the poor, and the borrower is a servant to the lender. Okay. But then the third and final principle to wealth, which is going to be most of my conversation on tonight, is the third principle to wealth. The third principle to wealth states that you have to protect the wealth you have not yet created. Protect the wealth you have not yet created. And our scripture is going to come from Proverbs 13 and 22. And it states, a good man leaveth an inheritance to his children's children. All right, next slide for me, please. All right, so as we transition to the next slide, let me first talk about how money works. Most people are concerned about money matters, but few truly understand how money works. So basically, your money should be working for you when you're not working, and your money should be working for you when you are working. Meaning, you shouldn't have to go work 2, 3, 4 jobs to make sure your money's working for you. You just got to understand how it works. Okay, next slide for me. And as a financial coach, I teach people on how you want to become an owner of your money, not a loaner. So I want to lay a foundation first before I go into a little bit more details about that third principle. But you want to become an owner of your money, not a loaner. As Dana was asked a question about, okay, when do you expect to retire? I believe retirement is not an age. Retirement has nothing to do with an age. It has everything to do with you having options. And when I say options, meaning you have enough money saved up where you don't have to go to work unless that's something you want to do, not because you have to go do it. And so as I was bringing in income, I was making money, my parents always taught me to take my hard-earned money and put it into your traditional financial institution. Those are like your credit unions and your banks. And that's what I was doing, but I noticed my money was never growing. And the reason why it was never growing is because what the banks and credit unions will do, they'll take your money, my money, and they'll invest it into the global economy. And so, what is the global economy? It's anywhere where you and I spend our hard earned money. So, it could be the grocery store, the gas station, the mall, Amazon.com. Wherever you spend your money, that's the global economy. And once I realized what the banks and credit unions were doing with our money, I said, I got to teach others how to do the same. And I'm going to talk to you tonight on how we're going to protect this wealth. So when I say protect the wealth you have not created, this is money that you have not saved just yet. Next slide for me. And so one concept when you want to understand how your money works, it's called the rule of 72. And some of you that have been into one of my sessions, you probably heard of this rule before, and more than likely you have been applying it ever since you learned about it. For those of you, if this is your first time hearing about this rule, the rule of 72, they call this rule the money rule. Okay. I'm sorry, they call it the banker's rule. I call it the money game rule. Meaning, if you don't know the rules that the financial institution play with your money, how can you win in the game of money? So my oldest daughter, she's about to complete her freshman year at Georgia Tech. She's a chess player. And my youngest daughter, she's a third grader. She also learned how to play chess. But if they didn't know how the rules work, if they did not understand the rules to chess, how would they know if they're a winner or loser in that chess match? Okay. The same with your money. If you don't know the rules, you cannot win. Now, the rule of 72 basically means if you take the number 72 and you divide it by whatever interest rate you're earning on your money. So your checking account, savings account, 401k, wherever your money's at, take 72 divided by the interest rate, and that will equal how many years it takes for whatever dollar that's in that account to double. So for example, let's say you had a 3% interest rate and you had $10,000. If you take 72 and divide it by just the number 3, not the percent, but the number 3, that's going to give you 24. So what that means is going to take 24 years before that 10,000 doubles one time to 20,000. And then 24 years later, which is year 48, that 20,000 now doubles to 40,000. And for those of you that may be taking notes, you can write down on your paper that 43% of Americans, when they retire with less than $20,000 saved. And I'll probably come back another session and talk more about how you can start saving. Let's say you had a 6% interest rate. 72 divided by 6 is now 12. So every 12 years, that 10,000 is doubling. So that same 10,000, 48 years later, will double to $160,000. Now, the global economy that I was referring to over the past 50 to 60 years has been earning a 12% or better rate of return. So now 72 divided by 12 is 6. So every 6 years, that money is doubling. So that same $10,000 at a 12% interest rate, 48 years later will double to 2.5 million. So how do you win a game if you don't know the rules? You can't. And who would benefit from learning this rule? I think everyone should benefit from this rule. And I believe this rule should be taught in our schools, but they don't teach it in schools. I believe the moment they teach us how to divide, they should be teaching the rule of 72. Okay. So now that I showed you how your money should be working for you, how to get this money to grow, now we got to see, or now we need to have a discussion on how do you protect the wealth you have not earned. Thank you. So let me give you the stat. And when I talk about protection, that's making sure you have adequate life insurance in place. Okay. Outside of your job, because what you have on your job, you don't own it. The moment you leave your job or they let you go, you're no longer part of the group, you don't keep the group benefits. Therefore, you got to make sure you have something outside of the job. So there's a stat that states that nearly half, 48% of Americans have no life insurance coverage at all. Over 100 million households have no life insurance coverage at all, or they have less coverage than they need. Okay, next slide for me. And so when we talk about life insurance, we're talking about income protection. And let me kind of illustrate this using this toaster. So let's say you had a toaster in your kitchen, and on the 1st and the 15th of every month, $2,000 popped out of it. So that's $4,000 a month. Would you like that toaster? Absolutely, you would. Would you put insurance on that toaster so that you can guarantee $4,000 every single month? Absolutely. But unfortunately, there is no such toaster, but you are the money machine for your family. So when I state protect the wealth you have not yet created, that's making sure you have adequate life insurance in place. 9 out of 10, if you go back one time for me real quick, 9 out of 10 African American, Middle Americans have no life insurance in place outside of their jobs. Okay. And my wife and I, we got big in this industry. Why? Because we were the ones literally going to funeral after funeral after funeral, passing the hat around. And the hat typically will come down my row a whole lot more often. And the reason why they say, well, Jason, you graduated from college, you have all the money, you should help. I said, no, that's not how it works. Yes, I graduated magna cum laude from Florida A&M University, but my job is not to take care of you when you pass away. We have to be more proactive than reactive. What I mean by that, we'll put insurance on our cars, our homes, our tablets. We'll even put insurance on the packages we send through the mail. But why is it when it comes down to our life, we don't do that? And oh, by the way, unfortunately, GoFundMe is not a life insurance plan. Okay? Counting on the church to always try to, hey, let's help. Well, we got to be more proactive. Fish fries, car washes, we have to be more proactive. Next slide for me. Okay. So let's talk about, let's say you put your money into a bank. Okay. You have Bank A and Bank B. Let's say in Bank A, you put your money into the bank and they stated, you know what, for the first 3 to 5 years of you put your money in this bank, you cannot touch your money for the first 3 to 5 years. You can't touch your money. They also stated while your money is sitting in that bank, you may be earning a 4% rate of return. Now, we just learned that 72 divided by 4 is 18. So that means it's going to take 18 years before your money will double. They also stated, well, while your money is sitting in this bank, if you ever need some money out of this bank, you can go get some money out of the bank, but you must borrow it. And when you borrow the money, you have to pay it back at an 8% interest rate. Would you bank at that bank? So you're earning 4%, but you got to pay it back at 8%. Okay. They can hold your money for up to 6 months. And when the individual die, the bank keeps the cash, your families get whatever the benefit or the death benefit is. You probably will not bank at that particular bank. Now, Bank B states your money is credited to you immediately. Okay. You're earning anywhere between a 10 to 12% potential rate of return on your money. If you ever need money, there's no fee or no borrowing. Why? Because it's your money. You receive your money within 24 to 48 hours. And when the person passes away, not only do you get the cash or what's in the investment account, you also receive whatever the death benefit is. Okay. So what I'm talking about, if you go to the next slide for me, Bank A and Bank B, there's 2 types of life insurances out there. One is called cash value or whole life. The other one is called term. Okay. So Bank A, in the example that we just showed you previously, that was cash value or whole life. That's designed where you have a, let's say, a high premium, low death benefit. So in this example, John and Mary has $150,000 each in cash value whole life insurance. They're paying $295 a month for $300,000. Now, I commended John and Mary for having life insurance because they beat the odds, because 9 out of 10 of us don't even have it. But I said, John and Mary, I notice you have no coverage on your children. You do know that sometimes your children could pass away before the parents, right? And they never thought of that. And a lot of us don't think about that our children may pass away before us, but it happens sometimes. Therefore, we got to make sure the children are properly protected as well. So then the other type of insurance that I would recommend it was term insurance. Term insurance allows the individual to get more coverage, pay less in premium for a specified period of years. With a term, you can have anywhere between 10, 15, 20, 25, 30, or 35-year term. So now John and Mary has 400,000 each, 10,000 on all their children, for a grand total of 810,000, paying 126 a month. So I saved them in this example $169. And so what do you think I told them to do with the 169? I told them to take the 169 and invest it into the global economy. So they took the 169, invested into the global economy over a 35-year period at a 9% interest rate, and they have well over $500,000 saved. So, ladies and gentlemen, just know life insurance is only needed if we pass away too soon. But if we live too long, that's where you want to have your investments in place. So I don't want you to really have life insurance your whole life. I want you to have investments your whole life. But until the individual completes principle number one, which is save, and until they complete principle number two, which is getting out of debt, we got to make sure that they are protecting their income with adequate insurance. And as we go to the next slide, this is just an example of what we got to make sure that you have to understand what life insurance covers. So some people think, well, it just covers the funeral. No, it covers more than just the funeral. So in this example, this was a couple, and they both bring home 3,500 each, so 7,000 together as a couple. You don't see the husband in this picture is because the husband passed away. So here we have $7,000 worth of bills that was being accrued by a couple. But the moment one of the couple, in this example, the husband passed away, those $7,000 in bills, they don't go away because that person is no longer here. So where the life insurance come into play is to cover the mortgage so that the house is paid off. It's there to cover any debt they have, so cars, credit cards, utilities. There's enough to put the kids through college. So life insurance, income protection is not just for the funeral. Okay. And some people, you also want to make sure you have enough to make sure you're covering the debt. You have some people think that, well, when that person died, the debt dies. No. I've seen situations where an individual was underinsured and they had so much debt that a lien was put on the house and the family lost the house and didn't have a place to live. Because some people thought, well, that person died with all this debt, the debt should die with them. No, we got to make sure you have enough in coverage to pay off the debt. Okay, you got to have enough in coverage to pay off the debt. All right, next slide for me. Another type of insurance or life insurance out there outside of the cash value whole life or the term is one that's called an IUL. They call that an index universal life insurance policy. Okay. It still is designed just like a whole life policy, but the money is being invested into what they call an index, like the S&P 500. It's still designed where you have a high premium, low death benefit. So in this example, John and Mary has a IUL at 250,000 each, and what's in their cash value is 127,000. So what is the cash value? The cash value is if they ever need money, That's how much they can borrow. But when they borrow the money, they have to pay it back with interest, as I shared earlier. Okay. So we recommend them to get a term policy, still at 250,000 each. Okay. But they're only paying $88. And you take the difference of the 251 and 88, that's $163 that we told this client to invest into a Roth IRA. And so that same 163 at I want to say a 9% interest rate, they now have over $300,000. So with that 300,000, if something happens to this family, not only will the family get the term policy, they also will receive what's in the investment account. Okay. And also, if this individual needs money, they can pull the money out the IRA without borrowing it. Why? Because it's their money. So just know insurance is insurance, investments are investments. Never merge the two together. Always keep them separate. Okay. For those of you who have car insurance, you cannot go to your car insurance company and say, hey, you know what? I'm going on vacation. It's spring break next week. I need to borrow $5,000. They're not going to let you borrow $5,000. For homeowners insurance, you can't go to your homeowners insurance company and ask to borrow some money. We can't go to our health insurance company and say, hey, I need to borrow some money. Therefore, you don't want to have a life insurance product where you have to borrow money. Keep it separate. Insurance is insurance. Investments are investments. Okay, next slide for me. And so now on here, we have what we call the theory of decreasing responsibility. Everyone that's on this live and anyone that was born, we were all born with two estates. We were born with a living estate and the dying estate. So there's little sort of like the aqua blue, that's called your living estate. The living estate basically states that in the earlier years, you may not have enough money saved up right now. But as you get to your latter years, 20, 25, 30 years from now, you should have money saved up if you are properly investing and diversifying your money. But with the living estate, prior to you saving up that money that you're looking to protect, there are people that are depending on your income. So you may have some young children or grandchildren or even parents that you're taking care of. You may have some debt. You may have a mortgage. So a loss of income will be devastating to that family. So with the living estate, you also have to build in what we call your dying estate. What's the dying estate? That's the green looking line. That's the life insurance. Because in your earlier years, you have to have enough protection in place. Why? Because you don't have enough money saved up. But in your latter years, your responsibility should be little to none at all. Why? Because you have enough money already saved. So as you get closer to retirement, you have grown children, and the children should be out the house, even though I hear they come back, but they should be out the house. You should have little to no debt. Your mortgage should be paid off as long as you did not go and refinance. And so then you have your retirement income. So you have money saved and no debt. I call that person self-insured. If you have money saved and no debt, the need for life insurance will be little to none at all. Okay, so the need for life insurance will be little to none at all. And so if we go to the next slide. So our vision for change, I'm here to save millions of families from financial ruins, the families that the large corporations do not care about, help them protect their families, get out of debt, and learn how money works. And so as I mentioned, my focus on tonight, Dr. Brewington asked me to focus mainly on that income protection. And the month of April is they labeled it as Financial Literacy Month. So I appreciate this opportunity that they have allowed me to share. And I always tell people, if you follow those three principles, number one, save, number two, get out of debt, and number three, protect your income, I guarantee you, you and your family will create generational wealth. So we want to make sure we're passing down generational wealth, not generational debt. And one way that you pass down generational wealth is making sure you have adequate life insurance in place. Okay. We want to make sure that the next generation is not starting off with a negative number. You want to make sure the next generation has it better than you have. And you hear some people say, well, I'm not trying to leave them all that, or I don't want to leave this money because I don't want them partying on me. No, if they are properly educated on the importance of the life insurance, there won't be any party because they do right by the money. They should be paying off debt, mortgage, education. The list goes on and on what needs to be covered. Okay. And so next slide. So as we wrap up, and we're going to open it up for questions, I provide free financial coaching. Here's my contact information here. Feel free to reach out to me, and we can put your own personal financial game plan in place. Because I believe that economic empowerment will change the narrative. It's just we got to make sure we're educated on what to do with our money and know exactly how money works. And that's one step that's lacking. That I want to make sure that I'm not only the change agent, but we have other leaders that can also be that change agent. And so that's what I have for tonight, Dr. Brewington. I think we're gonna open it up to see what questions individual may have.
Yes, thank you. Thank you, Jason. Oh my goodness. And as many times as I've heard you do this presentation, I still learn something new each and every time. So we thank you for your time. We're going to open it up for questions. Please just put your question in the chat. It will be highlighted, and then Jason will answer that. But I just want to go over a couple of things that just stuck out to me. I love how you said retirement is not an age, but it's having options. It's
Mm-hmm.
having options. And so that's what I'm trying to do, is to create some options. I love how you gave us the scriptures behind the three principles of wealth. So it's all in the Bible.
That's
Okay,
right.
these are biblical principles that even the world follows. So they might not know it's from the Bible, but they're following those principles. And so I just really love how you broke down the um, term insurance versus whole life insurance, and that we should not have to have insurance our whole life. That just makes so much sense to me every time that you bring that up. So thank you so much for just giving us this great information. Now, I did want to um, ask a question. You talked about generational wealth, and you had that the theory of decreasing responsibility. And
Mm-hmm.
so you showed how when you're younger, you may have, you have less money, but you have a lot of responsibility. So your
Mm-hmm.
children, grandchildren, can you talk to us about how can you protect your grandchildren or children? Are there policies that you can enact even now?
Yes, absolutely. So any child or any child under the age of 18, they can be what they call a child rider on their parents or grandparents policy. And it's very minimum as far as the amount that it will cost for someone to add a child. For I tell people, for children, minimum of 15,000, because God forbid if something happens to our kids, that's enough to cover the funeral. But 15,000 may be an extra $10, $11 a month,
Mhm.
but that covers all children and grandchildren under the age of 18. So yes, they definitely go ahead and get protected now, especially while they are young and in good health, because we
Right.
don't want to wait to down the line and let's say all of a sudden health challenges come about. Now it may be kind of hard to get them approved, or if they are approved, they may be rated and their premium may be a little bit higher. But the sooner we can get the children covered, actually they can get covered once they are at least 15 days old. So the moment they are at least 15 days old, that child should be added to their parents' policy.
Wow.
And then
15 days.
yeah, 14, 15 days. And now once they turn 25, they'll come off their parents' policy, and that's when they'll get their own adult policy.
Okay. Now you mentioned all the grandchildren, all your children. So
All
is there a maximum number
there,
that you can cover?
no, there's no maximum. You pay one price for one child, and all the other children and grandchildren are riders for free.
Now all the grandparents in here, you ought to be getting that contact information. I don't know if you can post that again. Thank you. Look at our producer. Thank you. Okay, so you all can have that information. Thank you so much. Wow, I didn't realize it was just one price.
Yes.
Okay, okay. So, what do you think about? You mentioned 25 as being the age that you can get your own insurance, but what about that 21
Yeah.
To 25? You know, they just graduated college. Should they stay on their parents, or
Yeah.
can they get their own?
Great question. So yeah, so if they're under the age of 18, they'll be a rider to age 25.
Mm-hmm.
Anyone that's 18 and older, they'll automatically get their own policy. So yes, that 20-year-old, 21-year-old. So my daughter, like I said, she's just started her freshman year at Georgia Tech. She'll be 19 on this Saturday, but she has her own adult policy at age 18 that, of course, I pay for. But I said, let me get her more coverage for less, and she's going to pay that same amount for the next 35 years. But then at the same time, she has an IRA that she's putting money into every single month, $50 to $100 a month into. So 35 years from now, she'll have well over $500,000, $1 million saved, where she shouldn't still need this $150,000, $250,000 life insurance policy.
Right.
So yes, the 18, 19, 20, 21, they need to get their own policies now.
Okay. Wow.
And if the parents want to be the ones responsible for making the payments, they can.
Okay. Okay. Thank you. This is some great information. Do we have any questions from our audience? Y'all come on and get these questions here. I know in the past, while we're just giving anyone an opportunity, you mentioned that you also will review our current life insurance, or because you talked about at the job how now it might be kind of going into the investments too. Yeah, like your 401k and things. So I'll just stay on subject. But you mentioned that when we have a job, and if you're fired from that job or terminated or whatever, that life insurance stays with the company. Is that correct?
That is correct. And you're right about that. I do free policy review to go over what you have, because some people think they got whole life, but it's actually term. Some people think they have term, but it's whole life. Some people don't know what they have, and they actually have accidental death. And what accidental death means is that individual, in order for that policy to pay out, you have to die in an accident. Okay. So I know a young lady who had 5 accidental death policies on her husband. Her husband died of a stroke. That was not an accident. So all 5 of those policies were no good. And so in her mind, she thought that she had life insurance, but what she had was accidental death. So I do complimentary review on what you currently have. Same on your job. People don't realize on your job, it's a reason why they give you one time your salary for free. There's a reason why if you want 2, 3, 4, 5 times your salary, you pay maybe like $7, $8 a month, because you're part of a group. So you're getting a group rate. Okay. But the moment you separate from the group, you don't get that rate. They're not going to pay for you because you're no longer part of the group. Also, with the group plan, it is designed where you have to work a 40-hour work week. So don't go out on short-term, long-term disability, and then you pass away, and then you think that they're going to pay the claim. They probably not. You have to work so many hours to consider that benefit. which is why you have to have something outside a job. I'll give you a quick example why it's important to have something outside a job. I know a young lady that was a school teacher, an educator, and she was teaching in one county, and she had life insurance with this one county, and her daughter passed away, and she was leaving that county going to another county. So when her daughter passed away, she went to her previous employer and said, "Hey, are you going to pay the claim?" And that previous employer said, "No, you don't work with us anymore. You need to go talk to the other county." So she goes to the other county and talked to them and said, "Hey, are you going to pay the claim?" They said, "No." And she said, "Why not?" "Well, because you have been working with us for at least 90 days.
Long enough.
So therefore, there was no life insurance to be paid out for her daughter. So she had to do a GoFundMe.
Wow.
Okay. And I'll give one other example. I know a police officer that was doing off-duty security. So wasn't doing work on the job as a police officer. You know, they don't make enough money, so they're doing a side gig at a club. And that person ended up getting shot and killed. And went to the police department and said, "Hey, are you going to pay the claim?" Like, "No, because he didn't die during duty. It was something he was doing on the side." So it's very important to have your own policy that you own, because I'm all about financial independence and not being dependent on an employer.
That's it. All right. We have a question on the floor.
Okay, if I'm several years into a 20-year term life policy, are you advised not to get another term life policy? Oh yeah, I would recommend that you renew that policy for another 20 years. But in the meantime, also, I'd like to take a look at what type of investments you have, because you may have enough money already saved up where you may not need the 20-year term. So we have to look to make sure that you may be out of debt, you have money saved up. So the need for that 20-year term, you may not still need to renew it, but it's going to be a case-by-case situation.
Okay.
I recently had some job changes and no longer have life insurance. At 55 too late. I'm interested in life insurance. Oh no, 55 is not too late. I can help anyone from 14, 15 days old all the way up to age 71 and a half, initially doing the policy, up to 71 and a half. So no, it's not too late.
Okay.
Okay, we answered that already. Okay.
Okay, did we answer that one? Okay, I just had another question. So when you're reviewing to see if we have enough life insurance, so you say you will review our policy, is there a certain amount or percentage that or calculation that you can look at to see if we have enough?
Yeah, you have some experts say at least 10 times your annual income. That's a good starting point. But I also look at not only the 10 times your annual income, but I also want to make sure what I call the bare minimum is covered in someone's policy. Meaning, I want to make sure we have at least enough to cover their funeral. I want to make sure we have enough to cover whatever they owe on the mortgage. And I also want to make sure we have enough to pay off any debt that they have: student loans, credit card loans, car loans. I call that the bare minimum. Okay. And the reason why we want to make sure the debt is paid off, so they don't come back and put a lien on the house we just paid off. Now, I have some people that say, "Well, Jason, we don't own. We actually renting." Okay, no problem. God forbid if something happened to either one of you, I don't want the surviving family member to worry about paying rent or paying mortgage ever again. Okay. So if you were looking to purchase a home, what price range would you be looking at? And whatever they tell me, I want to make sure that's also included with how much they need to get in life insurance. Okay, so that's the bare minimum: funeral, mortgage, and debt. And then I also will add, if they have kids, making sure they have enough for education. So I always tell people, if I'm here or if I'm not here, I want my girls to go off to college. So I want to make sure I have enough to cover if something happens to me prior to me saving the amount of money I need to save.
Okay. Now, many people will say they just can't afford life insurance, Jason. It's just not in the budget. Just can't. That's for later. I'll have to think about that later. What do you say to that?
The minimum is $15.
Okay.
The minimum is $15
So that's
a
about 2
month.
Starbucks
Yeah,
coffees.
yeah, even though the minimum is $15, but I'll tell them this: you have a cell phone, right? Yeah. You put insurance on that? Yeah, I got insurance on that. You drive a car, right? You got insurance on that? Yes. So we put on insurance on cell phones and cars that brings no value back into our family. We can find money to get life insurance to put on our life. To your point, maybe instead of going to Starbucks 5 days out of the week, just go just 3. You'll be surprised how inexpensive life insurance is. We just got to make sure we get it. So if someone say, I can look at your budget and we can cut back some areas where we'll make sure that you can afford life insurance.
All right. All right. Can we have your information placed back for those who still may need that, the contact information? Thank you so much. And we just thank our Pastor Tim Brunton for producing for us tonight. Thank you so much. Thank you. I also see another question here. We have a few more minutes so we can answer that. Can we put that question up?
Is it still possible to prepay for seminary plot? If so, is it a good idea to do so? My parents did, and it helped a lot. Yeah, I think they have something. I'm not too familiar with how the funeral home work, but I believe there's people that actually prepay for their plots. You just go to the funeral home and follow that process. And yes, that'll be one less expense you have to worry about when it comes down to covering the funeral. I believe that happened with one of my loved ones. We prepaid for everything, so I would say yes, it's a good idea. But in addition to also having life insurance, because in that example, that only covers the plot. That might also cover just the funeral. But then we got to look at all the other responsibility that may be left behind. If there was a debt, if there was a mortgage. So even though we're prepaying for just that, we still may need extra to cover the other responsibilities.
Awesome. Thank you so much. Thank you. This was just so informational. Thank you for just providing this information as we are beginning our financial literacy month. My mother also did the prepay, and she was probably about 75% paid in full. But because of the life insurance and investments that she had through you, we were able to take care of everything. So it is a good idea for the prepay. So thank you for that information. Jason, is there anything that we can right now? Is there information that we should be gathering, that we should be writing down, God forbid, something were to happen to us, if we were to have a stroke, if we were to pass away soon, that we should have for our families, such as passwords or important documents? Is that something, or a website or something that we can go to know where to gather all of that?
Yeah, I would recommend looking into doing estate planning, wills, and trusts. Individual can get with an attorney. I have someone I can recommend, but yes, you want to get that information in place. Your last will and testament. So yep, there you go. Will, trust. Yep, you definitely want to get that in place now. And a lot of people in our community, yes, we have wills, but a trust supersedes a will. So you definitely want to look into getting a trust, a living trust, because you can always make changes to that while you're living. So that's what I would recommend, getting that in place. And then, yeah, you can put in password. You can put all that information in for password, your banking information, all your assets. You could include all that into your trust. Matter of fact, once the trust is set up, you can put the trust as a beneficiary on your life insurance policy. It's just so much that could be done to protect that. That's also part of protecting your income.
Okay.
Is looking to have a trust in place.
Okay. All right. So Jesus Loves is Bridget, I believe. So I believe you know her. So she does have a question.
Okay. What's the question? I don't think it's did it pop up.
When is your attorney's next webinar?
Oh, I actually, Bridget, I forwarded you the email, and
Oh, okay.
you'll be actually be able to get on her distribution list, and she'll send out a email blast on the next one. But I am looking for her to do one personally for me as well. But I'll keep you posted. But if you look at that email I sent, it was today. You'll be able to sign up for her weekly webinars.
All right. Well, thank you, Jason. We are so glad to have you. And if I might add, y'all, this is his kid's spring break, the first day. So he is actually in Florida. So we're a little jealous, but I just appreciate you taking the time to speak with us tonight. And I'm just going to let you have any closing words. And we're going to get ready to log off. But thank you so much from the bottom of my heart. We appreciate you just informing us and just equipping us to protect our futures and to save for our families and our future generations. Thank you, Jason.
No, you're welcome. And once again, I appreciate you, Dana, and Pastor
Mhm.
Tim for having me on here. And as I mentioned, ladies and gentlemen, my goal is seriously, I want to help families create generational wealth.
Mhm.
Yes, these type of conversations we don't have across the kitchen table. We're not talking about these at the family reunion. But the moment someone dies, the first question everybody asks is, "Oh, do they have life insurance?" So
Mhm.
we got to make sure that once again we are more proactive than reactive. We have to have these conversations. Make sure your children are covered, your grandchildren. Everyone needs. Don't wait till you can't get insurance, and then you go into the church and asking, "Okay, can you help?" No, we gotta do better. We gotta do better. So let's be more proactive than reactive, and let's go ahead and protect our income now, because tomorrow is not promised. So
Mhm.
don't hold off. So yes, you heard this information today. Yes, I'm on spring break, but I'm here to help. So definitely reach out to me, and let's put things in place for your family now. And I'm licensed in 25 different states. And if I'm
Mm.
not licensed in your state, I can easily add it in a matter of 2 days. So that's all I have, Dana. And thank you once again for allowing me to speak on this evening.
And is Minnesota one of them?
Minnesota is one of them.
All right. Well, God bless you. Thank you all. Please make sure you like, comment, and share. We want this just to go viral. Please share it with your friends, your coworkers, those who you may not have seen tonight who were unable to make it. Please like, comment, and share. We thank you so much. God bless you, Brother Jason.
All
We'll
right.
see
Have a
you
good one.
next time.
All
Thank
right.
you. Good night.
Good night.